Beijing, who is on and off record stepping up its de-dollarization efforts, selling US debt to finance gold buying. It's not just China. Into 1 trillion of US debt being entered into every 100 days, staggering. India and the UAE central banks are also stealthily swapping US dollar debt for gold. Why wouldn't you? And also, the most recent official monetary and financial institutions forum, the OMFIF, that survey reveals that 15% of global central banks on record plan on increasing exposure to gold over the next 12 to 24 months.
China is actively selling U.S. debt to buy gold as part of its de-dollarization efforts, driven by the desire to avoid potential sanctions and the weaponization of U.S. debt. This trend, highlighted by Andrew Maguire from Kinesis Money, is not limited to China. India and the UAE also exchange U.S. dollar debt for gold. According to Bloomberg, in the first quarter, China sold a record $53.3 billion worth of Treasuries and agency bonds. This move is reminiscent of previous strategies where China unloaded U.S. debt to support its weakening yuan. The yuan has again depreciated against a strengthening dollar, prompting China to increase its gold reserves, which now constitute the highest share of its reserves since 2015. China's significant selling of U.S. debt has raised concerns in the market about higher yields. This trend accelerates amid deteriorating trade relations between Beijing and Washington, suggesting a deliberate step back from U.S. financial instruments. Maguire notes that the banks acting as agents for the Federal Reserve have a deep understanding of the gold market and are heavily invested in physical gold for their portfolios. They anticipate a rise in gold prices, a sentiment echoed by J.P. Morgan in its 2024 commodities outlook, highlighting gold and silver as the only structural bullish calls across commodities. According to UBS Group, gold's price surge is unique and primarily driven by macroeconomic factors rather than supply and demand dynamics. Following regulations requiring London Bullion Market Association banks to back their gold bullion with physical gold, it is clear that the Fed supports these net stable funding ratio compliant positions. The requirement for physical backing of gold positions can affect the liquidity and pricing of gold, potentially increasing demand as banks adjust their holdings to meet regulatory requirements. Join us as we delve into Andrew Maguire's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
The banks that are acting as agent, they know what's the writing on the wall. They're very close to the market. And of course, they're long and physical gold for their own books. They know the gold price is going up higher. So looking at the Fed agent bank main actors, the OCC report has 4 of the largest bullion bank derivative positions by name. And these are the positions stick-handled by the Fed's agent banks who are sanctioned by the Fed to operate gold accounts held at the Bank of England. Now, following all LBMA banks being forced to physically back the gold bullion they actually make markets on, there is little doubt that the Fed is flywheeling these NSFR-compliant bullion positions. And given that these banks are without exception long gold for their own books and openly projecting much higher prices, any bullion they loan to the Fed is guaranteed to be paid back by the Fed, in essence, providing these banks guarantees to underwrite these losses. And this explains the action, but as we now have just outlined, the scope of what can be short covered into the follow-through selling is simply limited to what can be siloed amongst the cash-settled CTAs inside the COMEX. Now, to prove this, the listed banks flywheeling these OCC derivative bets all have bullish price targets for their own books. I mean, Citi has forecast a gold price of over $3,000 in the next 6 to 18 months. Goldman Sachs, $2,700. UBS, an average of $2,365, and a year-end target of $2,600. A two-year forecast of $2,800, while J.P. Morgan and the Bank of America both have gold projected at $2,500. So in summary, all the first-tier bullion banks hold price targets that are significantly higher than the underwater official bets at $2,300. So drilling down into this post-non-farm payrolls game sell-off ahead of FOMC later today, we opened the week with half of Asia, as I say, including China, absent on Monday, with the most with most people knowing the Fed is snookered into trying to cap gold, they should have been, most people really were on the sidelines, quietly accumulating these dips and waiting until FOMC dust settles. All this short-term action is being capitalized on by Beijing, who is on and off record stepping up its de-dollarization efforts, selling US debt to finance gold buying. And of the two first-tier assets, only one is debt-free and is not at risk of being weaponized against China, who is increasingly being sanctioned by the US. But it's not just China. It's not just China. Into 1 trillion of US debt being entered into every 100 days, staggering. India and the UAE central banks are also stealthily swapping US dollar debt for gold. Why wouldn't you? And also, the most recent official monetary and financial institutions forum, the OMFIF, that survey reveals that 15% of global central banks on record plan on increasing exposure to gold over the next 12 to 24 months.
The strategic shift from U.S. debt to gold by Brics nations is accelerating, driven by concerns over potential sanctions and the weaponization of U.S. debt. Andrew Maguire indicates that Brics central banks, particularly China's, are accelerating their gold purchases despite officially reporting no new acquisitions. China, the largest official sector buyer of gold, is discreetly continuing to buy. Industry experts at a recent conference noted that China is expected to resume its gold purchases once prices ease from the record highs hit in May. After 18 consecutive months of increasing its gold reserves, the People's Bank of China reported no changes in May, causing a sharp drop in global spot prices. Maguire highlights that the timeline for these gold purchases aligns with the upcoming Brics initiatives. The final structure of the Brics currency will be finalized at the New Development Bank meeting in Shanghai this September, ahead of its formal launch at the Brics Summit in Kazan in October. A Brics representative from India confirmed that the bloc aims to have the Brics currency ready within the next 3 to 4 years, targeting a launch by 2027. Let's get back to the interview.
Following what we recently reported on the successful conclusion of the beta testing of Glasnev's 40 to 45% physically backed blockchain currency, which very loosely takes the form of the unit linked here, but it's actually adjusted to ensure that it is going to be ring-fenced outside of Western influence. And coming off last week's St. Petersburg Economic Forum, engaging the direct participation of the president of the Brics New Development Bank, Dilma Rousseff, the final agreed structure will be agreed fully in September at the New Development Bank meeting in Shanghai for the formal launch, really ahead of the formal launch at the Kazan Brics Summit in October. The currency is scheduled to be launched ahead of the US elections, and this imminent timeline has accelerated Brics central bank gold buying. So reports you hear of China central bank no longer buying gold, it's what they officially report. Of course, they don't want to be seen to be buying, but you cannot hide what they're doing from a monetary gold perspective, which is completely unreported. So really, these de-dollarizing moves have just not gone unnoticed by Western central banks operating under the BIS umbrella. They're not stupid. And while the BIS has been working on a central bank digital currency stablecoin since way back 2021, they'd assumed the proposed Brics currency would take the form of just an SDR-like FX currency, incorporating a blend of largely emerging market currencies. Now, due to these inherent trade imbalances, they figured a viable Brics non-dollar denominated currency was at a minimum 5 years away, providing time for the BIS to create the central bank digital currency that would absorb and control these non-dollar based currencies. Now, they're not banked on Glasnev's option 2, which is a polycentric gold and hard commodity backed currency being developed and tested in such short order completely underestimating the progress timelines as they now wake up to an unfactored hegemonic threat to the Western central banks, bringing forward really the BIS efforts to get in the act by issuing a CBDC, which will be partly backed by gold. Now, we'd looked at this BIS proposal when it was first proposed back in October 2022. And you can see here, and as we assessed at the time, it was no coincidence that this was the exact moment when the BIS concluded the squaring and buying back and de-risking the decades-old 500 to 700 tons of high counterparty risk derivative bets. Now, we drew particular attention to this notable event just before gold was revalued by the BIS as a first-year asset class on the 1st of January 2023. Now, this was the exact moment when the BIS and its European-facing central banks diverged from the Fed's mandate of suppressing FX gold against the dollar. In fact, we noted at the time every single central bank except the Fed went long gold. Over the 2 years, this so-called Enbridge central bank digital currency has been tested. On Wednesday, June the 5th, it formally reached the minimum viable product stage, inviting further international participation.
Considering the potential for increased gold prices due to heightened demand and the development of a Brics currency by 2027, what are the possible long-term implications for the dominance of the US dollar in international trade? And how should investors and policymakers prepare for this evolving scenario? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.